Money.
Tina Mitchell here with your Money Chat. We have seen a lot of red in the market. Mortgage-backed security and the stock market's trading lower this week on the heels of highly anticipated consumer price index report for January. And it feels like we're back in 1982 because this is the hottest reading since then. The headline, all inflation number rose 0.6% in January, and year over year number went from 7% to 7.5%. This is what I've been saying could happen, that we could be reaching a 7.5% inflation. Now, the core reading, which strips out volatile food and energy prices, was also up by 0.6%, and the year over year number went from 5.4% to 6%. So the 7.5% and the 6% on inflation is the hottest reading in about 40 years. Now, there is also some components here that discuss rental prices, and this has been a lagger compared to some of the other rental indexes that we get, like Apartment List and CoreLogic, which is showing 18% rental increases over the year. This one moved up a bit. The rental index went up 0.6%, and that pushed the year over year number to 3.8%. Obviously, an extremely hot inflation reading. And as I mentioned, we are getting close to the peak of inflation. Now, I do believe that next month we're going to be seeing a reading for February. You'll actually see the apex and the inflation of the numbers that we will be replacing at about 0.4 reading next month for the year over year numbers. If we see another number around 0.6%, guess what? We could see the year over year go from 7.5% up maybe to 7.7%. But after that, the comparison starts to get much more difficult. I do believe that we will see inflation start to come down, especially with the Fed stepping up in March to hike interest rates. Now, speaking of the Fed, of course, there's been some different expectations after the hotter than expected inflation reading. The Fed futures is showing that there is a 54% chance that the Fed rate hike in March is not only going to be a quarter basis points, but possibly 50 basis points. So that would certainly be a bit of a shock in the equity markets, but it would do some good things as far as curbing inflation. Now, do I think that the Fed will be hiking 50 basis points? I think it's going to be pretty tough to do so. Now, this week, we did hear from some of the Fed members. Loretta Mester, who is a voting member, said that she thinks that the Fed should hike by a quarter basis points, but she also said something interesting on the Fed balance runoff sheet. She stated that she thinks that the Fed should actually be selling mortgage-backed securities, and she thinks that they would move most of the holdings into treasuries and away from mortgage-backed securities. We will have to see how this all shakes out. This stuff is really important because when the Fed hikes rates, counterintuitively, it curves inflation on long-term rate like mortgage interest rates, and they usually respond by moving lower. But when the Fed reduces their balance sheet, that is usually bad news for mortgage interest rates. We will have to see how this all plays out as well, and how the Fed walks the tightrope here, trying to curb inflation, but also not upsetting the stock market too much. And that is this week's Money Chat.